the most powerful anti-silver institution in America, has just flipped sides. After a decade of suppressing the metals, they didn't just change their tone, they raised the alarm. $4,938 gold, $3,009 silver. And behind those numbers, a panic few will understand until it's far too late. This isn't just a price target, it's a coded confession that the vaults are empty, the delivery system is cracking, and the entire paper pricing structure is one margin call away from total failure. Why now? Why this number? And what happens when the West runs out of metal, but the East doesn't stop buying? Stay with us, because what you're about to hear may redefine how you think about wealth forever. Welcome to CSC Alert, where we don't predict markets, we decode them. If you're watching this and you're over 50, ask yourself, how many more cycles do you think we have left before the system resets? Subscribe, like your future portfolio depends on it, and let us know in the comments, where in the world are you watching from today? For years, Bank of America had a clear message. Silver was not worth the risk, gold was outdated. Precious metals, in their view, were just insurance policies with poor returns. They told clients to avoid them, favoring stocks, bonds, and tech instead. But on January 6, 2026, something unexpected happened. Bank of America quietly released a new research note. It didn't come with dramatic headlines or bold claims, but the numbers inside told a very different story. The same bank that once called silver a pet rock now issued a formal price alert, $309 per ounce. To understand the weight of this shift, we have to understand who is speaking. This is not a YouTube channel or a newsletter writer. This is one of the largest banks in the United States, a bank that holds trillions in assets, a bank that influences pension funds, hedge funds, and government policy. When a bank of this size changes its mind about silver, the market listens. The language in the report was calm, but the numbers were loud. For gold, they said it was no longer just a hedge. It should now be a core holding, between 20 to 30% of every portfolio. This is a major change. Banks usually recommend just 2 to 5% exposure to gold. Jumping to 30% is not a tweak. It's a warning, a red flag. And then came silver. Unlike gold, silver has always been seen as volatile. Some call it gold's wild little brother. But Bank of America didn't just suggest silver had upside. They released numbers tied to historical ratios, like the 2011 and 1980 gold to silver ratios, and showed that based on those models, silver could go not to $100, but past $300 per ounce. One scenario even projected $3,009 per ounce. Why such a dramatic change? Because behind the charts and ratios, something deeper is happening. Bank of America is no longer only reacting to price, they are reacting to a structural crisis, a problem hidden beneath the surface for years, a problem they can no longer ignore. They see the cracks forming in the global supply chain. They see silver inventories falling while industrial demand is rising. They know that countries like China are buying physical metal at record pace, and they understand that the entire pricing system, based on paper contracts traded on the COMEX, is starting to disconnect from the real physical market. For years, large banks like BofA could sell paper silver into the market without holding the actual metal. They believed they could always buy it back later, cheaper. But now, that assumption is breaking down. Premiums on physical silver are exploding. In some areas, buyers are paying $20, $30 above spot price just to secure real ounces. This is not normal. Bank of America knows that if this continues, the paper price will no longer matter. What will matter is whether you can take delivery, whether the metal is actually there. And if the answer is no, the credibility of the entire system could fall apart. So instead of warning investors away, Bank of America is now preparing them. This shift did not happen in a vacuum. Over the past year, central banks have been stocking up on gold. China has limited its silver exports. U.S. government agencies have started building new smelting facilities inside their borders. Large industrial buyers, solar panel manufacturers, tech companies, even defense contractors have started quietly securing long-term silver supply deals. And suddenly, a bank that once laughed at silver investors is now publishing a $309 alert. This is not a forecast for retail traders. It's not hype. It's a strategic repositioning by one of the most influential financial institutions in the world. And when an institution of this size moves, it's not just about belief. It's about survival. They see what's coming. They understand that fiat currencies are under pressure, that governments are printing money at record levels, that inflation is not going away. It's being redefined. And in that kind of world, silver is not just a metal. It becomes a form of protection, a form of strategic collateral. They also understand what happens during a short squeeze. They know that if delivery fails, prices don't just rise, they gap upward. They move in ways that charts can't predict. The nickel market showed us this in 2022. One day it was stable. The next day it jumped hundreds of percent in a single session. Bank of America is trying not to be caught on the wrong side of history. That's why they're switching their message now, before the full repricing begins. So, what should this mean for the observer, the investor, or the entrepreneur? It means that when the largest banks reverse their stance, it's not noise, it's a signal. A signal that the market is entering a new phase, a phase where supply chains matter more than algorithms, where physical ownership matters more than price charts. And this time, the signal is not subtle, it's flashing red. To understand why Bank of America issued this alert now, and who they fear is on the other side of this trade, we have to look east. While the West was busy debating interest rates and inflation percentages, the East had already made its move, and it wasn't subtle. In early January 2026, global financial circles were shaken by a massive update out of Beijing. The People, S-Bank of China, had expanded its M2 money supply by 48 trillion yuan, a figure so large it eclipsed the total U.S. money supply by nearly double. At first, this news was quietly discussed behind closed doors. But soon, the implications began to ripple outward. Analysts started asking the real question: where is all that money going? Unlike the U.S., where stimulus often flows into stock markets and financial derivatives, China's approach in 2026 was different, deliberate, strategic, and resource-focused. The $48 trillion wasn't being used to rescue property developers or boost stock indexes. It was being weaponized to buy real assets. Beijing had one goal: to convert rapidly devaluing paper into hard, tangible value before the global system reset. And at the top of their shopping list, gold and silver. They weren't subtle about it. Reports began to emerge of state-backed buyers sweeping global inventories, clearing refineries, draining COMEX and LBMA vaults, and offering miners higher premiums if they shipped directly to Shanghai instead of New York or London. This wasn't a market trade. It was monetary repositioning. And it sent a message to Western banks like Bank of America: the rules of the game were changing. For over 50 years, the US dollar system relied on trust, control, and settlement power. But China was now preparing for a world after that system, a world where currency value would once again be measured by what it's backed by, not just who prints it. By injecting 48 trillion into their economy and directing it toward commodities, China began laying the foundation for what some analysts now call a commodity-backed digital yuan. And silver, due to its dual role as a monetary and industrial metal, became a critical part of that strategy. This was the context in which Bank of America issued its $309 silver alert. They saw it too. They understood that a tidal wave of capital from the East was now anchoring itself to physical metal, not paper claims. They saw that every time the silver price dipped, even slightly, Chinese buyers stepped in with unlimited yuan to buy more, and this created a dangerous feedback loop for Western institutions. Because while the U.S. financial system still operates through leverage and synthetic contracts, what you might call paper silver, China was only interested in delivery. They wanted bars, not bets, ounces, not options. This caused a breakdown in the traditional pricing mechanism. Normally, arbitrage keeps paper and physical prices aligned. If silver trades cheaper on COMEX than it does in Shanghai, traders buy paper silver, stand for delivery, and ship it east for a profit. But now those deliveries were failing. Vaults were running dry, refineries were overloaded, logistics networks were stretched, and still, China kept buying. For Bank of America, this wasn't just an economic story, it was a warning. They saw a future where China's bid would become the floor, not COMEX. A future where Western banks would no longer be able to control the narrative with trading desks and leverage. A future where real demand in the East would overwhelm synthetic supply in the West. And this wasn't just about investment, it was about geopolitics. Silver plays a critical role in China's long-term strategies. From solar panels and electric vehicles to 5G tech and advanced weapon systems, China needs silver not only for monetary purposes, but for industrial and military dominance. Their planners know this, and so they're acting early. Rather than waiting for the West to raise prices or for spot charts to hit new highs, China is building inventory now using currency. They can print at will to acquire assets they know they'll need for the next decade. This is why Bank of America's reversal carries so much weight. Their $309 silver projection isn't IT just based on historical ratios. It asks also a defensive posture. They are responding to the East's aggression with a reluctant admission. We may have lost control. They can see what's coming. They know that once the Eastern demand reaches a critical threshold, silver won't just be repriced, it will be redefined. It won't trade based on COMEX futures anymore. It will trade based on physical availability, on who can take delivery, on who still has ounces left to sell. And when that happens, the gap between paper and physical will widen permanently. This is already visible in the premium structure. In the West, the official spot price may sit at $80, but try buying a 1/0 silver coin today, and you'll be quoted $95, sometimes over $100. Why? Because real metal is scarce and China is outbidding the rest of the world. For entrepreneurs, investors, and business leaders, this shift carries enormous implications. It signals a broader transition from financialized markets to resource-backed systems. It also highlights the danger of holding paper promises when global liquidity is flooding into real assets. Bank of America saw the writing on the wall. They saw the $48 trillion tsunami coming from Beijing. And they did the only thing they could: sound the alarm. Because once China finishes building its wall of metal, once the vaults in the West are empty, and once the delivery system fails, the repricing of silver won't be slow, it will be instant. While China was buying silver in bulk, another part of the world was facing a different kind of problem, one that had been quietly growing for over a decade. Western banks, led by institutions like J.P. Morgan and Citigroup, had built a system based on assumptions. They believed silver would remain cheap. They believed demand could be managed with leverage. They believed delivery could always be delayed. But by early 2026, those assumptions were starting to collapse. The numbers revealed a trap that was now becoming visible to everyone who looked closely. According to multiple derivative reports and bank participation data, the estimated short position held by major Western financial institutions had reached a staggering 4.4 billion ounces of silver. That figure wasn't a typo, it wasn't an exaggeration. It represented the combined exposure through futures, options, and over-the-counter contracts of banks that had bet for years that silver prices would stay low. Now consider this. The entire world mines only about 800 million ounces of silver per year. That means these banks had sold contracts for silver they did not own, equal to more than 5 years of total global production. To put it simply, they promised to deliver metal that may not even exist. In normal market conditions, these short positions could be rolled over, settled in cash, or offset by buying contracts later at a cheaper price. But in 2026, 3 major changes made that strategy extremely dangerous. First, the price was no longer falling. Silver had surged past $80, and premiums for real metal were hitting $100 or more. That meant every dollar increase in silver prices added billions in mark-to-market losses on those short positions. If silver moved from $80 to $90, the banks would face $44 billion in theoretical losses. At $100, those losses could exceed $88 billion. Second, the nature of the counterparty had changed. In the past, the person on the other side of a silver contract was often a trader or a hedge fund, someone who was happy to settle in cash. But today, that counterparty might be a solar panel manufacturer, a national defense contractor, or even the People's Bank of China. These are not entities that accept paper promises. They don't want fiat currency. They want the actual metal. For them, silver is a critical input, not just an investment. And that leads to the third and most dangerous shift. Delivery expectations are now real. When a bank is short a futures contract, it is essentially a promise. We will deliver silver at this price. But if the physical market is tight and vaults are empty, fulfilling that promise becomes a serious problem. As of early 2026, registered inventories on the COMEX, the portion of silver actually available for delivery, had dropped to under 300 million ounces. Against a short position of 4.4 billion, this isn't a cushion, it's a warning sign. If even 10% of contract holders demand physical settlement, the system would break. There simply isn't enough silver in the vaults to cover the exposure. That's not a theory, it's math. Bank of America, in its new report, appeared to acknowledge this indirectly. While they did not name specific banks or positions, their language pointed to systemic imbalance between synthetic exposure and physical supply. This is a careful way of saying the banks are trapped. And in a trap, panic becomes inevitable. Imagine the scenario. One large player demands delivery. The exchange cannot fulfill it. That news leaks. Other holders, fearing the same, also request delivery. Suddenly, banks must buy back contracts at any price to avoid default. This is what analysts call the short squeeze. But in silver, due to the sheer size of the short position, it would not be a simple squeeze. It would be a financial event, something capable of shaking trust in the entire pricing structure of commodities. The banks in this situation would not be negotiating from strength. They would be bidding into a market with almost no sellers. The investors holding silver are not quick to sell. Not at $80, not even at $100. Many of them believe the real value lies far higher, especially with China still bidding aggressively. So what happens when a major Western bank is forced to buy back hundreds of millions of ounces? They will bid higher. First $90, then $100, then $120. But there may still be no sellers. That's when prices gap up. Not in small steps, but in large, sudden moves. This is not just theory. We saw it happen with nickel in 2022, when a similar short squeeze forced prices to jump over 250% in a day, causing the London Metal Exchange to halt trading. But silver is a far deeper market, tied to more industries, more countries, and more investors. This time, there may be no circuit breaker strong enough to stop it. The worst case scenario is clear: a delivery default on a major exchange, a moment where the system admits we cannot fulfill the contract. If that happens, confidence in paper silver collapses. Spot prices become meaningless. Only physical availability will matter. For the banks, this is more than a trade gone wrong. It's a structural failure. They would be forced to chase the very asset they spent years suppressing. And for the investors, entrepreneurs, and business minds watching this unfold, one truth becomes clear. The price of silver is no longer controlled by the sellers. It is being controlled by the buyers. We explore how this shift in control has already broken the price system, and why the number on your screen may no longer reflect reality. As the silver market entered 2026, a new kind of split appeared. Not a chart pattern, not a sentiment shift, but a structural divergence between the price on the screen and the reality in the vaults. It was subtle at first. Spot silver prices on the COMEX rose to $80. Investors celebrated. Analysts praised the rally. The media called it a strong performance. But something strange was happening in the physical market. Buyers picking up the phone to place real orders discovered a different story. Dealers were no longer offering 1-ounce coins at $80. Premiums were rising, fast. Some dealers quoted $90. Others asked for $95 or more. In some locations, premium coins exceeded $100 per ounce. This wasn't just a temporary spike. It became a consistent pattern, and it told a very important story. The paper price, the number shown on websites, apps, and futures exchanges, was no longer in sync with the true cost of acquiring silver. The market had officially split in two. On one side, there was synthetic silver, contracts, options, ETFs, products that track silver prices but do not require delivery. On the other side, there was physical silver, actual bars and coins held in vaults, safe deposit boxes, and personal safes. This divergence had been building for years, but now it was visible to anyone paying attention. Premiums were not rising because of hype or speculation. They were rising because supply was drying up. Western vaults were being drained, Eastern buyers were not selling, and refineries could not keep up with demand. Still, many retail investors didn't understand. They looked at $80 on the screen and thought, that's a good price, maybe I should sell. They assumed the price was real, but it wasn't. This was the $80 trap, a well-designed illusion. Western banks, sitting on billions in short exposure, had a powerful incentive to hold the paper price below panic levels. Algorithms were deployed. Stop-loss hunts were triggered. Volatility was introduced to shake weak hands. The goal? To push silver holders to sell before the real squeeze arrived. To flush physical metal back into the system so that delivery obligations could be met, quietly, at manageable cost. But smart investors were not fooled. They realized something was broken. In a healthy market, price differences create arbitrage opportunities. If silver is cheaper on COMEX, traders can buy contracts, stand for delivery, and sell the bars to dealers at a higher price. The profit closes the gap, but by 2026, that arbitrage stopped working. Delivery delays were growing, vaults were empty, transport costs were rising, the metal simply wasn't available. This meant one thing: the spot price had become irrelevant, and that created a dangerous situation for anyone relying on paper exposure. Silver ETFs and futures were no longer backed by readily available metal. Their supply chain was strained. Their custodians were drawing from the same shrinking inventory. And if confidence in redemption collapsed, those paper assets would fall, even as physical silver soared. This is the risk Bank of America appeared to acknowledge in their new research. By projecting a $309 silver price, they weren't just modeling inflation or demand growth. They were preparing for a repricing event, a total shift in how silver is valued. Because once paper pricing fails, markets don't adjust gradually. They snap. It's happened before. In 2022, when nickel contracts couldn't be settled, the London Metal Exchange was forced to halt trading, cancel trades, and rewrite rules. But silver is far bigger than nickel. It sits at the intersection of finance, energy, defense, and global trade. It is not just a metal, it is a strategic asset. And once the illusion of spot price is exposed, the consequences will be fast and irreversible. Buyers will stop trusting futures, sellers will stop honoring paper, prices will not rise. They will re-rate, jumping from $80 to $150 overnight, bypassing all intermediate resistance. That's why premiums matter. They are not a temporary inconvenience. They are a signal, a thermometer for a system running hot. And that brings us to the real choice facing investors and businesses today. Do you trust the number on your screen, or do you trust the actions of central banks, energy companies, and sovereign buyers who are draining the physical market every day? China is not watching silver charts. They are buying silver quietly, in bulk. The Pentagon is not betting on spot prices. It is investing in domestic smelting capacity, securing supply chains. Industrial users are not trading silver for profit. They are locking in long-term deals before the price escapes orbit. They're not chasing price, they're chasing availability. Because once the physical supply is gone, price will not matter. The question will no longer be, how much is silver? The question will be, is there any left? And that is the final warning. The silver market of 2026 is no longer about speculation. It is about survival. It is about owning the asset that cannot be printed, cannot be duplicated, and cannot be replaced. What this means for businesses, for investors, and for the global monetary system as the silver revaluation era begins.